Good afternoon, everyone. We're just about to get started. We're going to give everyone another minute or two to join, and then we'll be introducing our speakers. Just one more minute before we get started. Okay, we wanted to welcome everybody this afternoon to give you some background information on NAIOP. It's the Commercial Real Estate Development Association, one of the nation's leading trade associations for developers, owners, investors, and asset managers. New York City is one of the fastest growing chapters of NAIOP Corporate and provides members with unparalleled industry networking, educational, and socially conscious programs and events, in addition to advocating for effective legislation on behalf of the commercial real estate industry. We have an excellent program for you this afternoon, the 2020 Legislative Update and State of the Multifamily Market webinar. I would like to introduce our two speakers today, Mitchell Flaherty, Director of Investment Sales at B6 Real Estate Advisors, and Robert Setagatpour, Founder and Principal at Stratco Property Group. Just a couple of quick house cleaning items. Everyone will have an opportunity to submit their questions. You should see that on the dashboard on your desktop. We will be saving the last 15 to 20 minutes for audience Q&A, and we'll get to as many questions as possible. With that, I will turn it over to our speakers.
Thanks, Kate. So, hi, Mitchell Flaherty here. I work with B6 Real Estate. We are an investment sales and debt advisory platform in New York and New Jersey. In the commercial real estate world.
Rob Setagatpour, principal at Stratco. We are a strategic consultant. We deal with the strategy related to landlord-tenant consulting, which was very effective over the last real estate cycle on value-add strategies. And we recently opened up a new division dealing with the recent climate legislation and its impact on multifamily. And we're a total solution provider in that space. So in today's session, we're going to be focusing on changes, clarification, or new introductions of law since the Rent Act was introduced in June, and also outlining market changes, market opportunities, and opportunities where we can capitalize in the change that's recently happened. So we all know what happened in June. In City Council's perspective, they're not done yet with with equalizing the playing field between landlords and tenants. They've recently proposed 7 bills that's passed City Council. It's waiting the mayor's signature on a number of items that they want to do to equalize that. It's pretty self-explanatory here on what the topics are or what the bills are. A few of the things that we think are mission critical we're going to be discussing in detail today. But if people have specific questions, they could send it over during the presentation or we could address it afterwards.
So Rob, I'm seeing a few, very few buyouts in the market. Are they handicapping the process even further?
So we're going to get to buyouts in a minute. Let's start with security deposits. Big ticket item here is tenant is scheduled to vacate or is vacating, have their security deposit check ready with a receipt for them to sign so they can get it on their way out. There's been really hundreds of incidents where tenants had their security deposit return meaningfully delayed, or there was reductions on the security deposit that in their minds wasn't fair. So this bill is really attempting to basically clean up those issues. So an owner manager's goal right now is return it upon vacate, get the receipt signed so you don't have to deal with the administrative issues that are coming up.
So,
go ahead.
Sorry, Rob. As I was saying, I was jumping the gun a little bit there. I'm seeing very few buyouts in the market. Are they handicapping the process even further?
So they want to add a level of administration further. This may or may not achieve their goal, but if a company or an owner has an above board and transparent operation, really a method to their buyout process where they're documenting it appropriately and they're identifying the appropriate candidates and conversation points, they don't have to really worry about what's being proposed because everything should be in line with what they're doing. And they're not attempting to basically stop buyouts in entirety. It's that they want to protect those tenants that may not benefit from such a negotiation. So MCIs and IAIs, we know what passed and how they really paralyze this end of the industry. MCIs, it's still worthwhile on buildings that are 100% rent regulated, and with that, buildings that have high legal rents. So if you have a building that is 100% regulated with high legal rent, your returns are going to be much higher than a building that has a lower regulated count and also has an average rent that's lower. IAIs. So the formula that they now have in place is really it's really irrelevant, and it's really not necessarily worth it to do any types of improvements, as we all know. But there still are 3 value add formulas that's as of today still apply. One is substantial rehab applications on buildings that are either vacant or predominantly vacant, where you're replacing the building, more than 75% of the building systems. Perimeter changes on rent regulated units. Let's say, for example, you have a rent stabilized apartment that's 1,000 square feet. Rule of thumb is if you change 90 square feet of the apartment, our office's rule of thumb is that you should really be changing it by about 25%, up or down. So this could be combining it with a neighboring apartment, taking a portion of a basement space or a neighboring space to change it and really renovating and creating an entirely new apartment with new layout. And then the third is rent-controlled units upon vacature. The next rent, which should really be the market rent, becomes a new legal rent. So if you have a rent-controlled unit that's paying, say, $100 a month in a neighborhood where that unit can achieve $3,000 a month, there's still a meaningful value add there. So if you have buildings with a high number of rent-controlled units, those still have some value to focus on. Prep rents. So we all know, both of us know that the Bronx has a high number of buildings with prep rents because of the number of units that were recently renovated there the last six years during the last cycle. We also know with the current legislation that what the tenant is currently paying on their prep rent is really their base rent, and the escalations that are being applied go off of the lower prep rent going forward as long as they're the tenant in the unit. However, upon vacature, the owner is able to capture the legal rent on that unit. So in neighborhoods or situations where you have a high number of prep rents in a building, those are still a value add strategy, especially if you're anticipating there being greater market growth in that neighborhood. And outside of this, we'll talk about it a little bit later on, really perfecting your paper trail on those buildings.
So yeah, thanks, Rob. Just to echo that point, so buyers I'm speaking to are paying very close attention to the preferential rents when underwriting, because, as Rob mentioned, this is effectively the only value-add opportunity remaining. This is more prevalent in the outer boroughs because there's a wider gap between the rent stabilised and the preferential rent. Because as we know, it's gone from a future cash flow business to a current cash flow business where buyers are effectively clipping a coupon. So yeah. Moving on to the next slide.
So what's the impact of all of this legislation or changes that have happened on the market?
So as you all know, there's been a significant impact since the June regulations. The tenants' arguments for these proposed regulations were owners having an unfair advantage. There were some bad players in the market taking advantage of the MCI and IAI opportunity. Industry organisations such as CHIP and RSA are working on a lawsuit that was going to take a significant amount of time to be realised. And the basis of this lawsuit is alleging that it has represented illegal taking of private property. Some would say the damage is already done. Time will tell in the circumstances. The grounds for these lawsuits are as follows. As we all know, expenses in running multifamily buildings in New York is getting increasingly more expensive, 6 to 8 per annum, whereas your rent increases is 0 to 2% per annum. So the landlord's argument is how much is someone going to pay for a diminishing cash flow? Another point they're clearly making in the proposed lawsuit is that the Department of Buildings permits are dropping significantly. This is where clients of mine are having to lay off their contractors, which is not good for the labour workforce. And the reason why they're doing it is because obviously through the IIs and MCIs, they're not incentivised to invest in their buildings. Another point is that the city transfer taxes are significantly reducing because there are simply fewer transactions in the market. This is going to have an impact on the budget of the city, of New York City, so that deficit is going to have to come from somewhere. So I'm selling a rent stabilised portfolio at the moment, and a few of the general thesis from the buyers is there's going to have to be a large amount of capex required where previously there wasn't. So the first point is the initial capital expenditure to remediate the violations that would previously been repaid by MCIs. Another point is the adjusted cap rate going in. So as I'll come on to next how it's affected the market, but in the Bronx, for example, a market I focus on, cap rates have gone from 5.5% to 7-ish%, depending on the type of building. Another point in the underwriting is they have to allow for higher credit loss assumptions due to the inability to leverage or evict tenants where they are previously allowed to forgive arrears in return for the vacant unit to capture the free market rent. Capital improvement, due to the reducement of the MCIs and IAIs, they have to allow for capital improvement costs in their cash flow, such as a reserve or sinking fund to cover this cost. And the fifth and final point is that because of the tax budget deficit I mentioned, they're allowing for increasing tax exposure when underwriting their buildings. So how's this impact to the market? So on average, the market's been effective. Values have decreased 27% on average throughout the Bronx. So cap rates for rent stabilized products come from 5.5% to 7% on average. A couple of examples of this: Woody Crest Avenue, a building that traded in June, was in contract prior to the rent regulations and still traded at a 5.5 cap because there was a larger demand for a larger walk-up elevator building. Whereas if you compare that to Eagle Avenue, that was a 5.5 cap in contract prior to the regulations, where post-regulations it got retraded to a 7 cap. So, as we all know, it's a difficult market out there. The only thing keeping the buyers engaged are the cheap debt opportunities available, locking in long-term debt. If you're borrowing money at 60 to 70% LTV at a 3.5% interest rate, and you're getting a return of 7%, you're clipping that coupon and hoping that the legislation may change in the future.
So now going into really the housekeeping component of both the buildings that you may own, buildings that you're looking to sell, or buildings that you're looking to purchase. While we're dealing with the current environment, where it's really one of the key components is really risk mitigation. This current legislation is really the backbone on the exposure that landlords have on their buildings that have had IAIs or vacancy allowances over the unit rent pathology. So what we wanted to, outside of what's clearly labeled here, what we want to take away is you got to perfect your paper trail on how those rents were increased. So you may say, okay, what am I going to do with a unit that was deregulated or raised via an IAI 10 years ago? So, and you may say that the law only requires us to go back 6 years. However, if the tenant can show that there may be some element of fraud, the door is open for them to pursue that litigation. So to the extent possible, if you have relationships with those contractors, get affidavits, see if you could find pictures, receipts, cancel checks. You may want to reach out to the tenants that were in the unit before the renovation, immediately after the renovation. If you need details on really what is that checklist, you can reach out to us after. But we're seeing on a number of situations, the tenants that are behind in rent or looking to basically cash out before they vacate are hiring attorneys to start frivolous overcharge claims to see what they can bake in before they leave. This just further outlines it. It's the power is with tenants in this space, and to the extent you can gather your paperwork when you don't need it, it's going to be a much easier management process. If you're looking to sell a building, we're clearly advocating to Mitch's clients on the sell side to have a electronic file outlining how all those units rents were increased, giving a table of contents of what's included. So if someone goes in, does their diligence, they can, in one day, they can have a clear understanding of how those rents were raised and what's there to support it. And if you're looking to buy a building, you should have a clear checklist of what you're looking for so you can account for what risk you may or may not have. So while a lot of these laws were meaningfully changed through a law firm that we have a relationship with, we've been providing a disclaimer statement to our tenants outlining, while these laws have changed and we're dealing with riders that were created prior to the rent laws, that everyone is subject to change with what may be written here versus what the current law is. So again, to equalize the playing field, if you have a unit that has recent violations or complaints and you're pursuing a legal action against that tenant, you really got to have clean hands. How do you define clean hands? Is you can't have violations or open complaints on a unit prior to commencing a legal action against the tenant, because the tenant can come back and claim that this is a retaliatory intent for the open violation or the complaints that may be on the unit. This goes back to rent demands. This goes back to your ability to collect. To the extent possible, you want to control your landlord-tenant relationship in those communications. You want to collaborate with your tenants outside of court and outside of third-party influence, which are tenant advocates. It's going to cost you a lot more to do a non-payment case. It's going to take you a lot longer to collect that money. So to the extent possible, stay out of court and be mindful of what cases that you want to start because of the recent retaliatory intent legislation. Good cause eviction. This is proposed universal rent control on limiting the increases on free market units. This is in committee. They're attempting to pass this spring. It hasn't become law yet. What you should take away from it is, to the extent possible, you want to raise your rents on your current free market units now. Buildings that you're looking to purchase, you should have a strategy in place if this does pass, and you should really just be aware of what's being proposed, not necessarily that it will pass. So the next slide, which is slide 21, outlines proposed rent control on commercial spaces. Big takeaways here is this is being proposed to the extent possible that you want to value add your retail. You should do it now. You may want to focus on larger, more credit-worthy tenants as opposed to taking a risk with a mom and pop operation where you may end up being married to that tenant for a significantly long period of time if this does pass. So what's the state of the city right now? So the mayor's office is continuing to unleash more and more agencies with government funding. Most recent one is Mayor's Office to Protect Tenants. It's basically, they have an office. You file a complaint within 12 hours. They're sending someone to that building to go assess the findings and then come up with a case to basically pursue against the landlord. What's not being picked up here is a number of actions being commenced by landlords is really, it's minimal these days because there's no incentive to do anything because you can't raise your rents. And even if the tenant is doing something outside of their lease terms, you're very gun shy on pursuing anything because you're not going to be able to benefit from it financially. So this slide really outlines the budget of legal aid. So if you see in 2013, it was 22 million. 2019, it's about 8 times that amount. This, in my opinion, has reached its peak because legal aid budget went up as the number of legal actions commenced from landlords to tenants was also increasing. But those cases are very flat, and there's almost very few holdovers being commenced. So the caseload of these offices, these public offices, is very low. A lot of these offices are very slow, or they're attempting to engineer cases where there may not be. And as you can share with many of your colleagues in the industry, they're getting hit with lawsuits that don't have the merits. Over the next few years, this is going to meaningfully dry, and this budget is also going to drop because they don't have the demand of work that they've had over the last few years. History repeating itself. You know, a lot of people entered this business over the last 10 years when there was an upswing, but this industry and this product is very cyclical. Similar thing happened in the late 60s when there was a housing boom. 73, they adopted rent stabilization. That really quieted the market for years, and it wasn't until, go to the next slide, really 93 that that they created all these value enhancement laws on how to raise your rents. Where the government is today is that they're saying that they've lost almost 200,000 regulated units, and the average rent in the 5 boroughs is at an all-time high, while people's income levels haven't gone up in that same amount. While we're seeing these drops, basically a net loss every year of units leaving stabilization, what they're attempting to do now with the current legislation is that same net positive growth in rent stabilized units being added to the system before they meaningfully change these laws again.
So Rob, we've been looking at a few deals together that I'm listing and how we can add value by cutting operating costs, therefore increasing your net operating income, therefore increasing values in buildings. So Rob, what's going on here? How can we give the audience a background on what it is and how they can benefit from this?
Right, so the public, the city, and really the industry has been overwhelmed and really overly focused on the changes of the laws that impact the landlord-tenant relationship and value enhancement mechanisms on the top line growth. But prior to that, in April, there was historic legislation really in the nation on New York State and the city declaring that they want to create a carbon neutral city and state, and they want to electrify the energy consumption in the city. And by doing that, it's going to meaningfully transform how these buildings are run. So let's, over the next few slides, we'll see how that's been impacting those deals that we've both been looking at and the opportunity that exists today for owners. So the big picture where all of these slides are going to take you is that there's a tremendous amount of financing and rebates available to value engineer your operating costs, really your energy costs, and how to run these buildings. Between city, state, and federal funding available, for those first movers that want to retrofit their buildings, they're able to do it where almost the entire cost will be paid by third parties, and you can cut your operating expenses minimum on the energy between minimum 25 up to 90%. If you have the vision, you have the bandwidth, and you have the focus and the right team in place in order to do that. So on this slide 28, it outlines some of the local laws, not all of them, but maybe the biggest ticket items that impact buildings. So the next slide, slide 29, outlines basically what can get done. We can put on new roofs, we can add solar or green roof, retrofit the lighting, upgrade the appliances, the windows, have all of the soft costs paid through 100% financing. So those deals that Mitch, we've both looked at where they've had really out of whack utility and fuel costs, where it was really crushing the deal, especially if these deals were trading at, let's say, between a 6 to an 8 cap. Those, for our most visionary clients, those had the most benefit because we were able to come in, pro forma what we needed as far as a budget, where we were getting that money from outside parties, going in post-closing, having that money accessible, and then, over the next 2 years, anticipating a refi outside of the other value enhancement strategies, but really retrofitting a lot of their operating expenses and creating value there outside of creating greater NOI. So typical payback, lighting, we're getting a 5, lighting, solar and boiler controls, it's between a 4 to 5 year payback. And a lot of the other products, whether it's putting on a green roof or retrofitting the common areas, those paybacks, while you can't necessarily pencil it on paper, will impact the retention and the rent growth on your free market units while we're having it being financed and capitalized through third parties.
So just to summarize with the opportunities today, just to echo a couple of Rob's points. If any clients, any landlords looking to sell their buildings, it's key to perfect your rent history documentations. Buyers don't want to go on a wild goose chase to find this information. They want to mitigate as much risk as possible. Create an overview approach on how to cut a building's energy and operating costs, because that will effectively increase your NOI and its value. So the sort of deals I'm inviting my clients to look at the moment are buildings with high amount of preference, because that's the effective juice left in the deal, but also large utility costs that can be decreased, and again, increasing the NOI. It's also key to have a due diligence checklist, so how to mitigate the risks such as current leases in place, receipts and checks, and a copy of any contracts, any IAI documentation since 1993, and store everything electronically. There's not many buildings out there that have a clean bill of health in terms of its paperwork. So if the building you own does, then it makes it much more attractive to a potential buyer.
So we have one question that came in related to IAIs, and the listener mentions they're sitting on 5 vacant units. And what do they do now? They didn't want to, obviously they can, but they don't want to do the typical renovation because the payback's not going to be there. So while we don't want to answer it in detail and take up everyone's time, but one thing you want to do portfolio-wide is take an accounting of your rent-controlled units, take an accounting of those units that you have vacant, where you can combine it or partially combine it with a neighboring unit, possibly sending a buyout letter and offering that neighboring tenant to relocate into another apartment where you can have 2 units next to each other and do a perimeter change, or first floor units where you can do a drop down and combine it with the basement. The few buildings that someone may have in their portfolio that are either vacant, sitting vacant, or you can deliver vacant, you may want to consult with either an office like ours or your own consultant on looking into a substantial rehab application. Next question that we have is related to, while I'm hearing stories of my friends getting hit with overcharge complaints, what should I do in my portfolio, both on buildings that I've owned for over 30 years and the buildings that I bought over the last couple of years? So this, for many of us, it may sound like just a lot of running around with little payback. Oftentimes pursuing doing this cleanup when you don't need it it's a better use of time than when you get hit with a lawsuit claiming that you inappropriately raised those rents. So you should really have a checklist of basically what you're looking for. Have someone on the administration level first gather what they can find. Then you may want to source those people that did the work, either contacting the seller or the manager of the building that owned it at that time, and start putting everything together electronically and just really having accounting on Excel for those units that did have those increases and what you have in place. So you should really do it building by building and really go from there. So question that came in is, what happens with those buildings that have a regulatory agreement, whether it's a J51 or 421A that's expired? So to our understanding, those buildings that do have regulatory agreements in place, upon expiration, as long as the appropriate riders are there for each of the stabilized tenants, upon that regulatory agreement expiring, and that tenant that was in the unit prior to the expiration vacates, that next tenant becomes free market. So that applies specifically to buildings that have regulatory agreements and some sort of tax incentive in there. So next question that we have is related to buildings to purchase. So we clearly have attractive financing in place.
Yeah.
We have an increase in cap rates. We have a decrease in collections. We have an increased budget in deferred maintenance. We have almost no budget for value enhancement, CapEx, because the incentives aren't there. And what do we do now? Do an accounting of your pref rents, do an accounting of your rent-controlled units, see the spread between the legal rent on those pref rent units to market. Do have your consultant, your energy consultant, do an analysis of what you may qualify for on that building based off of the current energy consumption, and do a pro forma of basically what value add you can do on your operating expenses to basically cut those costs within the first 2 years, how it can be capitalized, and how that may end up benefiting your NOI. So one other question that we have come in related to retail. What are we doing with, what should we do now? It's still a little bit vague how this bill will impact us. If you're sitting with a vacant unit right now, they haven't clearly outlined what penalties may be assigned to it, but they're giving clear direction that units that are up for expiration, if you can't negotiate a renewal together, they may sub it out to an arbiter to determine what that escalation amount shall be. So you should just really use your disclosure on units that you have retail that's expiring, what you want to do now to negotiate that prior to this possibly going into law. So final things, you want to just share what you're seeing as far as your own deal flow on buyers of what people may want to look for or reach out to you for?
So yeah, I'm been underwriting quite a few buildings recently that I underwrote a year ago, and it's just working closely with Rob. It's never been more important to understand the expenses in relation to the building and how you can cut that in expenses to increase your value. Because I'm saying to all my clients at the moment, you shouldn't sell now unless you have to. A lot of buyers think the market's going to come down even further. It's all yet to be seen. I'm just advised to get consultants to look at the building and really understand the dynamics of that building and its location.
So a question came in on the tenant buyouts. Do we even bother with it? So the incentives aren't there to do it portfolio wide, but if you are going to do it, you just got to have your system in place. If you know that the person is not a candidate for a buyout or they're not going to be interested, you're better off not reaching out to them. If you are going to reach out to specific tenants, you have to document everything, and you should err on the side of caution. So first, send the disclosure statement, send it with the proof of mailing. Keep a record of all the conversations. So if you do get audited by a third party, or they do inquire on what the history of the conversations are, you could show them something that is, very rarely provided, which is basically a document trail on those conversations. Thank you very much for joining us. If you have specific questions, both on market opportunities, what your property is worth, or the current deal flow for the South Bronx, please reach out to Mitch at B6. If you have strategic questions on value add strategies, both on your rents or on energy retrofits at your building, you could reach out to myself, Rob, at Stratco. And thank you very much for joining us today.
Thank you, guys. Have a good day.